So hi, today I'm going to be to Carl Espray, CEO of Contango Holdings, ticker CGO, a company that I recently invested in. Good to chat to you today, Carl.
Hi, Darren. Yeah, good to chat to you too.
Yeah, so yesterday you put out an RNS concerning the acquisition of the Garalo Gold project in Mali. Can you tell us a little bit more about the deal and why the company sort of expanded into the sort of gold arena?
Absolutely, yeah. So Contango was formed a few years ago with the strategy of buying near-term production assets. So we've stated that we aren't an exploration company. We aren't here to spend money drilling to find the largest resource of any commodity in the world. We want to buy assets that are near-term production and therefore near-term cash flow. We can speak later, but the first acquisition we undertook was a coal deposit in Zimbabwe. That's a near-term coal, near-term cash flow from that asset, and we can speak about that later. But as you said, yesterday we announced the acquisition of the Garalo deposit in Mali. It's a 320,000 ounce deposit, but more importantly, it's a small bite-sized acquisition, and the mine construction will commence in January. So we expect cash flow probably second half of next year already from this mine.
Okay, yeah, that sounds interesting. And obviously going with a lower, if you like, sized resource, obviously gives you then access to, picking it up for, say, less money. I should imagine something like 1 million ounce resource would be a lot more and probably not achievable for the company at this stage. So, what you've got there is really something sort of smaller scale for the company to get their teeth into and then potentially expand out later on.
Yeah, absolutely. I mean, everyone is looking for 1 million ounce north and north deposits. So that's a very competitive space, competing for large deposits in Africa, but I suppose globally as well. I mean, just as an example, 1 million ounces in Mali will set you back about $20 million at the moment, and sometimes up to $25 million. But in these sub 500,000 ounce deposits, there's very little competition. We aren't competing with any of the majors, and we aren't competing with any of the exploration shells, because they are having to build a much bigger story than we're trying to build in terms of the resource size. We are a cash flow mine producer. That's what we want to do. But what's interesting is we've picked up this deposit for $1 million, as you said, and there are surrounding deposits in the area. And when I say in the area, I mean within a circa 15-kilometer radius, where we can pick up other 300, 400,000 ounce deposits. And therefore we could build a 1 million ounce deposit. It'll be in contiguous tenements, and we can process that all on our main mine sites. So for us, it's a much more bite-sized, as you said, approach to getting to a large resource, and also one where we aren't going to be competing with every gold explorer to overpay for resources in the ground. And then just to follow up, we still think there's expansion opportunity on this resource. So we said 320,000 ounces, but there's 4 targets on the tenement, and they've only drilled 2 of them. So we expect to increase the resource size, but again, we're not an explorer. I'm not here to tell you that we're going to increase it to 1 million ounces. Even if we get up to 500,000 ounces, we can still have a 10 to 15-year life on our mine.
Yeah, well, that was actually one of my next questions. I mean, even a 10-year life of mine, at the 30,000 ounces per annum production, that's a pretty robust project in its own right. And if you could obviously expand that out, then even better. How achievable is that 30,000 ounce target that you mentioned in the RNS? Is that I think you mentioned something, you might need more capex for that. Is that the case?
Yeah, so we will need more capex for that, and we are speaking to royalty companies at the moment, and we're speaking to debt providers to provide debt for that size of a mine. And also, we wouldn't get there in one step. We'd get there in 2 or 3 steps. Again, using our organic cash flow to expand. But because of the gold price at the moment, you're looking at such healthy margins. You can imagine if margins are $1,000 on 30,000 ounces, there's still $30 million of margin per year for the company, and that's very achievable. I don't think we'd probably achieve that by second half of next year, but we'd certainly achieve something like 10,000 ounces by that point, and then we'd push to expand up to the 30,000 ounces as quickly as we can.
So what's attractive from my perspective about yesterday's news is that it's a near-term producing asset, and this is something that it's important to me given the current gold environment. I mean, no one knows really how long the sort of gold bull market will last for, and it could be for a while, but getting there into production near term is attractive for me. And obviously I like the idea of what you're saying about the company scaling out the gold proposition by picking up, say, smaller deposits. I mean, it's certainly in a prospective area from what I've seen. I had a look at the presentation this morning, and you've got neighbours like Barrick Gold and Endeavour. So and also I noticed that you'd said that some of the drilling had uncovered grades of up to 43 grams a ton. So it certainly looks an interesting area.
Absolutely. And just a bit of background on Mali, because it's somewhat of an unknown entity potentially if you're outside the gold arena. But Mali is the fastest growing gold destination in the world. It's the third biggest producer in Africa. And as you said, it's got many majors. The biggest is Barrick, who have 4 mines in the country. But Anglo Gold Ashanti is there with 2 or 3 mines. Endeavour, Hummingbird, as you know, from the UK, Resolute Mining, B2 Gold. Their main asset of B2 Gold is in Mali, and you see their market capitalization. And then there's a whole bunch of explorers that are all capped at, there are explorers in Mali who don't have a resource, like Roscan in Canada, that are trading on an 80 million market cap, or Oklo in Australia that are trading on a $130 million market cap. So there's a huge, there's a very well-established gold mining and gold exploring industry in Mali. It's actually significantly easier to build a gold business in Mali than any of the surrounding countries.
Yeah, I see it's well established. I see it's the 3rd largest African producer now. So
that's right.
Yeah, interesting. Yeah. So on the gold project then, what can we expect news flow wise next? So how do you get to that sort of all important first production next year? Have you got some more drilling to do? Have you got I think you mentioned something about a JORC, formalizing that?
Yeah, so the team is in site in Mali now, on site, looking for the placement of the mine and the mill. As I said, we're not we could drill those other 2 targets at a later stage, but the priority up front is to build the mine. We're going to spend some time taking the geological data. Although as I've said before, I've known this asset for 4 years now, so our geological team has spent a lot of time looking over it already. But we do want to take that up to JORC standard. It's important when you're trading in London that you have to report your resources to the JORC standard. When we've reported it, obviously we've always used the proviso that it's not JORC, but we'll take it up to the JORC standard in the next few weeks. And then come January, we're going to start construction of the mine. So there'll be updates on the mine construction, and as soon as is feasible, we'll start putting ore through the mill, and we'll start pouring gold.
Excellent. And that's funded from the raise that you did in conjunction with the acquisition, which I noticed was actually at market price. So that was a decent raise to get away, I thought, in this environment.
That's funded. We also again, similar to what we're doing in Zimbabwe, we're using contract mining which saves us a lot of capital on the operation, although it has a resulting effect on an increased operating cost. But in this gold environment, operating cost increasing by $100 is acceptable because the gold is it's trading at such high levels. As long as we then use the cash flow from the operation to backfill and boost our own capital, which is what I said, we'll be using our organic cash flow to expand the mine. We believe we can get our costs. The mining engineers believe we'll get our costs down to the $800 to $850 mark. And there's even potential to get it down to the 650 mark as we expand to the full 30,000 ounces. So we achieve those economies of scale.
Excellent. Yeah. Okay. Well, be very exciting, and we'll be looking forward to looking at more news flow on the gold asset. So obviously you have another very large asset as well, which first attracted me to the company, which is the coking coal asset. And I know some investors sort of almost switch off when they hear the word coal, but this isn't sort of just or isn't predominantly sort of like the thermal coal. This is high grade metallurgical coal, coking coal, which is obviously very important in the steelmaking process. How's that project coming along at the moment? I think obviously there's been a little bit of a downtime in Zimbabwe. Is that now back out of lockdown, or are we moving forwards there?
Yeah, so Zimbabwe is, well, I guess the whole Southern African region is now, as of October, has moved off their severest lockdown. They're down to tier 1 for them, which means international travel could come. There's a little bit of quarantining and testing that's needed to come in, but at all intents and purposes, our team has returned into Zimbabwe, and our team is now back on site in Mbinga, which is where the deposit is, the Lubu deposit. We are going to soon open up the first box cut on the coal mine. The purpose of that is that is where we will start mining, and B, to send samples away to these off-takers so large bulk samples off to the off-takers that we've signed the LOIs with. We've already sent them smaller samples, but the final step is to send them much larger sample sets. At the same time, we're also talking to two potential coke producers who are looking to build coke batteries on our site. Oh. So we're also sending a sample of our coking coal to be converted into coke and then tested by one of the independent labs. If that's positive, which we have no reason to believe it won't be, I think it's highly likely we will have coke batteries built on our site, and then that'll be a very long-term contract, because they obviously installing lots of capital on our site. So we'll have a long-term contract to provide coking coal for those coke batteries directly. And as you know, as you pointed out earlier, thermal coal is used to power the thermal power stations, yeah. Whereas coking coal is used in the production of steel or in the smelting in general, so ferroalloys, etc. So the coke, which is the product that they put into the blast furnace, is a product that the world needs still. Regardless, we can't. There's no renewable source of that at the moment.
I didn't know that you were planning to potentially actually produce the end coke from your site. I mean, that's obviously dependent upon whoever the third party is, testing the coal and what have you. Is that just a fairly straightforward process? I mean, how does coal differentiate from deposit to deposit? Is it fairly straightforward, or is there, are there sort of
it's the non-coal qualities that differ, the ash content, the sulfur content, and all of that has to be put through and then obviously independently tested by a lab, because anyone who owns a coal deposit will tell everyone that it's the best coal deposit in the world. So we have to prove that independently. What's interesting is if one speaks to these the steel industry and the producers of coke, they are getting increasingly worried about sources of supply for their coking coal, because as you can imagine, as you started off, many of the bigger mining companies are shutting down their coal assets, because there's always an element of thermal even in the coking coal deposit. So some of the bigger companies just are shutting all coal down. If you're a steel company that needs coke, you're starting to get a little bit worried about supply, which is why we've been approached by two coke producers, because they're excited about a large, multi-decade deposit where they can produce coke from.
One of the other interesting things, and it was a question that I had for you, because I was looking at the margins for selling the coal, and one of the biggest costs for you guys, I think, is, from what I've seen, is transportation. And whether you're if you're selling locally or having to ship it a long distance, there can be a big swing in potentially the margins. Presumably, if you could manage to get some plants on site, you don't have any of that. Does that reduce the transportation costs? Or,
no, it doesn't. It doesn't reduce the transportation costs, because the end product will get shipped to China.
Right.
But what it does is increase the value of the product. So the transportation cost stays the same. If for argument's sake, if it's $100 from our site to get to China, and coking coal is trading at 140, we're playing with a $40 margin. So as you said, if coking coal falls 40, we break even. But coke sells for $350. So it's still $100 to transport it there, and then obviously you have to add on another circa $50 to produce it. But you're playing with a $250 margin, or $200 margin, which is so if you're doing bulk transport, you need to transport the highest value item you can possibly.
Right. Okay. Presumably some discount to the guys that have actually put the equipment on site as well, though.
Yeah, of course. Or we can do a margin share. So those are the discussions to be had at the moment. how will it look? Will we just simply sell them coking coal, and then they take the margin, or will we enter into a JV and pay back the capital equipment with them? Those are the discussions to be had.
Okay. All right. So news flow wise, then on the coking coal asset, then can we expect to see potentially these letter of intents turning into sort of more formal contracts? Because I know that's the sort of like the trigger for production start.
Yeah, I think we're back in country now, so we're actually getting approached by more people. Obviously, having the profile of being on the London Exchange gives us a lot more profile locally, and so people are approaching us to sign LOIs. At the same time, we're opening up the box cut in the next few weeks, and that'll lead to us taking large samples, and very quickly from those samples being taken and tested, we'll move those onto the final offtake discussions. So I'd guess in the next 2 months we'll be having those final offtake discussions with people. Plus, if there's a positive, we might release the results of the coke. I don't quite know how we can communicate the coke, but if there's positive feedback on the coke testing that's done on our coking coal, I think it's highly likely we will move towards some sort of a coke battery on our site and a long-term contract on that basis.
Interesting. Okay. So both projects, African-based. A lot of investors will be aware of risks. Are there any? I always like to just cast my eye over risk, but is there how sort of confident should investors be in say Zimbabwe and Mali? We sort of touched on Mali. We've seen other big operators there like Barrick and Anglo Ashanti, so I think that's probably self-explanatory. But the Zimbabwe side, are there any other companies operating there successfully? You're quite familiar with the region.
Yeah, there's lots of. There's lots of mining in Zimbabwe. There always has been. It's one of the richest minerally endorsed countries in the world. There's a large platinum industry, which is Impala Platinum from South Africa, Anglo Platinum. There's a gold mining industry. You might know Caledonia. They've done extremely well in Zimbabwe. And there's a coal industry already, although it's largely a thermal coal industry at this point, feeding the power stations there. And then there's chrome and diamonds. There's a well-established mining industry, and there's never been a mining license taken by the government. Obviously, the Zimbabwean government has a legacy of having disruptive influence in the agricultural sector, but that's never really been the case in the mining industry. They had a very punitive indigenization policy at one point, which has now been revoked. But even that, it was, for all new assets coming in, you had to give up a large percentage to locals, and then people just didn't invest in the country on that basis. So they moved that, and people are reinvesting in the country. And then again on Mali, there's been some recent political instability, which is kind of largely over now. So there was a shuffle in parliament, and there was a military coup. But the old guard was moved on. But now it's been reinstated to civilian rule, and it's moving towards an election in the coming weeks.
Okay.
And as you said, very, very large scale mining industries. These countries know not to let politics interfere with their biggest industry, really.
Okay, well, yeah, thanks for summarising that. So I guess sort of coming towards wrap up, when do you think the company will be, cash flow positive? Both projects look like they're going to be operational 2021. Is that when we can expect to, start seeing cash flow coming in? I noticed also you mentioned a dividend policy. The company's got a dividend policy. It wants to implement, potentially up to 50% of, profits.
Yeah. So cash flows. I think second half of next year we'll see cash flows in the company, and to your point on the dividend policy, what we've said is once we are stable cash flows, and by that we mean there'd be no point us distributing money from the, we build a gold mine, we then get cash flows, and then we distribute that money to shareholders when we need money to expand the Zimbabwean mine. So I think once both are up and running, we will distribute 50% of the cash flow to shareholders. Okay. So again, you'd expect in 2022, for that point onwards, 50% of all cash flow coming from the company being distributed to shareholders, and the other 50% used for organic expansion or acquisition of surrounding gold deposits, as we mentioned earlier.
Yeah, I mean, it's quite attractive, because I was playing around with some of the numbers and looking at some of the projected cash flows that you've been talking about, you know, and the margins, what have you. You could be paying a significant dividend if it was a 50%. And given the shares in issue at this market cap now, you'd be, you know, you could potentially be looking at sort of an investment payback in, you know, 3 or 4 years. So that caught my eye as well. So I mean, I think these things obviously will need to be weighed up, as you say. You know, if you're expanding gold and there's a big opportunity in gold, like you said, some of these other little smaller deposits that you can then maybe, you know, expand it to a larger resource, there might be a trade-off to say, actually, do you know what, it's not right to return more money now to shareholders, because actually there's more value to be had by working up this or making this additional acquisition. But certainly like the fact that the company are looking to implement an early dividend policy, which is not something you see very often in the junior space.
Yes, I know, and it comes back to that philosophy of ours, which is get near-term cash flow, and don't. I'll say, obviously, I don't want to use the word waste, but don't waste too much money on exploration, because there's plenty of companies out there that are exploring that people can invest in. We are a cash flow company. We want to return that money to shareholders, of which management is a large percentage. And yeah, to your point, we're not going to, and maybe it's worth saying, we're not going to be doing many acquisitions now. So we're not, this won't be, in 2 months' time, you won't see us in Botswana doing something. We've kind of got our base now. It's time to build this, and then, as I said, organically expand around the area potentially.
Well, yeah, that's an important point, because people do get excited. Further acquisitions, what have you. But I've seen a few junior resource companies that are holding, say, 5 or 6 licenses, and they just simply won't have the cash to work those up or to extract value out of them. You just don't, it's hard enough for junior mining companies as it is to raise money and control dilution without completely diluting shareholders out. So what I like about Contango's model is that, you've got a couple of decent cash producing assets there that can, bring in further cash flow, or bring in cash flow, pretty much limit or negate any further need to go back to the market. And obviously with producing assets, cash flow, you can potentially tap into debt if you need to.
Absolutely, yeah. Or royalties.
Yes, yeah, okay. So we could potentially see something on the royalty front with one of the projects.
Yeah, I think so, and especially on the gold side.
Okay, great. Well, I think that's about covered it, Carl. I wonder if you could just quickly summarise, why you think investors should consider Contango Holdings, and what investors can expect to see over the next, say, 6 months in terms of news flow. I think the company's been pretty much under the radar, because I think you only did list, was it earlier this year, or was it back end of last year?
Yeah, we completed the reverse in June this year.
Oh, okay, right. So yeah, I mean, I think that's the thing. I mean, I've not seen any chatter on the company whatsoever. And I only myself really talking about it, and that's why I wanted to really do this interview as well, because I just think the market might need to, it's an interesting company, and obviously I'm invested, so therefore I'm kind of happy to chat to you. But yeah, if you could just quickly just summarise why you think investors would look at or be interested in Contango.
Yeah, of course. I think it's a different strategy, and it's kind of a unique strategy. We are looking for cash flow to be distributed to shareholders. I mean, as I said before, there's many mining juniors that are spending money on drilling and exploring, and good luck to them, but that's not what we do. We're a company that's very cheap in terms of the share price, if you look at the 2 assets we've got and the potential around those assets. and we will use the cash flow resources of the companies to generate cash, then use that cash to expand organically and distribute to shareholders. And that's in terms of the management team, in terms of the large shareholders of the company, obviously very established in the mining industry, RAB Capital, John Story, etc., all of which have been reported as large shareholders. And so we're very, very focused on that strategy. And I think that's a strategy that will, especially the dividends, will generate huge capital returns for the company as well, because that will be factored into the share price as soon as we can de-risk that for people.
Great. Okay. And then really over the next sort of, few months into early 2021, we can be looking out for progression on the gold project. And
correct. On the coal side, it'll be moving towards full offtakes and then commencement of construction there. And on the gold side, we are commencing construction in January. We're already happy with the resource. So, as we start constructing, the timeline towards cash flow will decrease each week, and we can obviously give updates on how the construction's going. But the next 6 months will be very busy for us on that basis. Okay.
Well, excellent stuff, Carl. Thanks very much for your time. That was very interesting, and hopefully we can catch up again in the near future as more news comes out.
Wonderful. Thank you, Darren.
Okay. Cheers.
Bye-bye.